and his company, that Green Accountancy, specialises in working with social entrepreneurs and charities. And David's got plenty of expertise, sort of first-hand experience of working with early-stage social entrepreneurs in getting them started off in the right way with their financial record. So hopefully you will all find the webinar really useful. So this webinar is part of a wider webinar series that Unlimited have been developing for the past couple of years now, actually. And today's is part of the 2014 series. You'll be able to find the recording of this session afterwards on our website, so you can listen again. You can also find recordings of the previous webinars, which some of you might have missed, but you might find useful. I will send you all the links and relevant web pages after we finish this webinar. So just a little bit about housekeeping for this session. So we have an hour with David. The webinar itself will last about 40 to 45 minutes, roughly, and then after that we will have time for questions. So have a think of questions throughout. You will see on the webinar dashboard, which you should see on my computer, it's on the right-hand side of the screen. There's a chat box, and you might have seen my little message earlier appear there. So any questions you have, just type them into that chat box. I will pick those up during the webinar, and then at the end we'll go through those, and David will answer as many as he can. So please use the chat box, and also to communicate to us if you are having any issues, but hopefully everything is working. So I think that's probably all that I need to say. So I will now hand over to David for the next 40-45 minutes, and then I will pick up again at the end with the questions. So over to you, David.
Thank you, Marika. Thank you very much, and good morning everyone who's joined the webinar. Thanks for joining in. I'll try and keep it lively as we go through what you might consider to be quite a dry subject, but hopefully this is going to be useful to everyone in terms of managing your social enterprise wherever you may be in that process. Obviously I don't know you, I can't see you, and that's always slightly challenging from the speaker's point of view. Obviously, if we were able to interact a little bit, that would be useful, and occasionally I might ask things like, where are people in terms of, are you starting up now? Have you already started your social enterprise? Also, what kind of structures you are. So that when those kind of points crop up, perhaps if one or two can just type in some details and Marika can feed back into the conversation, that will keep it flowing a little bit more smoothly. So a little bit about me. First of all, I'm a chartered certified accountant. I trained in a small practice working with small businesses, and have always worked with small businesses, and always had an interest in nature and thought that never the two would meet, until one day I found myself on a diploma for environmental conservation course and found that actually businesses were having quite a big impact on nature, both in the UK and worldwide, and indeed small businesses included in that. That led me to create Green Accountancy 7 years ago, and we've found that Green Accountancy actually is best placed to help social enterprises, small sustainability sector businesses, small charities and the like, with our bit of expertise, our bit of knowledge and experience, and hopefully that adds then to their projects and helps the whole thing go round a little bit more smoothly. So that's really the purpose of Green Accountancy. And this webinar exactly ties into that. This is really introduction stuff, might be a little bit basic. As I say, I don't know your individual situations, but we're starting from the beginning with no prior knowledge expected, and then there's some other workshops and seminars and indeed one-to-one sessions that anybody would be welcome to book onto by just getting in touch with me. So that's a bit about me and this particular, how I've come to be in this particular session. The first thing I want to talk about is really profitability of a social enterprise. Often the first thing many people will think of when they hear the word social enterprise is not-for-profit. I always thought not-for-profit was a really poor phrase for a business, and I now realise actually it's one of the worst business phrases ever invented. I think sometimes see the phrase not for distributable profits, and that's a slightly more interesting, more realistic kind of approach to social enterprise, but I quite like for profits and for good. Why am I talking so much about profitability and profits when we are, after all, thinking about social enterprise? And the reason for that is that profits are the #1 source of funds for future projects. Once you've established your social enterprise, you'll find that hopefully funds do accumulate a little bit within it, and those funds are then what's available to use for your future projects, and they're the most easiest accessible, the most flexible, and most importantly they're yours. They're much better source of funds than, say, bank borrowing or equity. So past profits will be a key source of funds for future projects, and that highlights the importance of profitability. Equally, it's quite obvious that it's very unlikely that any particular exercise that involves financial transactions is going to land exactly on 0 profits. Therefore, if we don't have profits, we've probably got losses, and losses can't be sustained for very long. So it's really important to plan for profits, and if you do plan for profits, then hopefully you'll have a future which involves funds within the project that you're actually undertaking, and a long-lasting social enterprise. So how do we go about actually getting some profits into the social enterprise? And my #1 tip on that point of view is pricing. Pricing is absolutely key. Obviously, the more we price, the more money we get for our services or goods that we're supplying. But it's not quite as simple as that. There's a well-known and age-old economics kind of equation that the higher the price, the less the demand. But that's not always actually true. And I find pricing a very difficult subject for a lot of social enterprises. If we compare what we might have as 2 identical projects, one operating as a social enterprise, one operating as a what you might call straight commercial for-profits business, it might be thought initially that a social enterprise would be able to, and maybe even thought to be required to, offer a lower price. Particularly if we go back to the phrase not-for-profits, we might be thinking in terms of the price covering the costs. We don't need to make a profit, therefore we can have a lower price. Unfortunately, it doesn't work like that. The for-profits business will tend to have what you might call sweat equity. We can have people working in that business who later are enjoying the value of their business and are willing to put in money or time and effort into the exercise without actually getting paid. Whereas contrast that with a social enterprise, and most normally, and certainly once things are off the ground, people need to be paid for their efforts because they're not actually building up a valuable business in their hands. So in that sense, a social enterprise has a higher requirement for profits from day one and to be able to pay for itself from day one. So pricing is at least on a par with any other commercial business. The next thing I'll say about pricing is that a low price can often lead to a deluge of work. Great. When you're starting off with any exercise, with any project, there's always a fear that will people actually want this service or this type of goods or products that you're actually offering. And by setting a low price, getting a lot of interest, that can feel that you've actually achieved something. Unfortunately, it can mean that you're snowed under with work that's not actually really making any profits. You can't afford to bring in the right kind of help, and that can then lead to a bit of a disaster zone in your social enterprise. So pricing too low and generating false demand by doing so is never a good idea. And then conversely, low price can actually indicate low quality. People will often judge the quality of a service, particularly on various factors that they can't really see. It's difficult to judge whether your particular service, perhaps you're helping people, I don't know, might be in a care home, might be in any scenario that you're offering to help a situation, and it's difficult for the buyers of that service to actually get a handle on what level of quality you're going to be offering. And one thing that people do, whether subconsciously or purposely, is judge quality by the price. In other words, the lower the price, the lower the quality. So I'd say low pricing is really really bad news for a social enterprise, and just get those prices absolutely in line with where the market will take you. The other tips that I've got in terms of making a profitable social enterprise, the next one is systems. You might call them procedures or checklists or a blueprint, but basically the idea there is to, when you're starting your social enterprise, work on your projects, work on what you're actually doing, but at the same time keep track of what you're actually doing and make that into a coherent set of instructions that somebody else would be able to follow. And then as time goes by, you can repeat that process and all the time fine-tune the instructions, the checklist or procedure that you're following, so that it actually really works. And at that point you can then start passing it on to other people to do, enable you to grow the project, find more contacts and so on, or even ultimately franchise the social enterprise such that it can be duplicated in different geographical regions or different social environments. So having a track of how to do things rather than simply being the one person doing thing, I think, is a key part of making any kind of business, whether social or otherwise. Just as a piece of background on that, one of my all-time classic kind of business books in terms of startup exercises is a book by Michael Gerber called The E-Myth Revisited. It has certain passages that you might choose to ignore, as any business book does, but it's quite a useful exercise in understanding why systems and how to actually work and how to actually make a business work as opposed to just doing a job of work. Other things that are always part of a successful business include records, having good basic records, nothing complicated, keeping it simple, but making sure the bookkeeping is right and fit for purpose. Reduce your risks, make sure there's agreements in place. If you're in a partnership, have a partnership agreement. If you're in a company with multiple shareholders, get those shareholder agreements in place. Those are some of the worst problems I've ever seen, where there's fallouts and there's no prior agreement in place. And get everything insured. Insurance needn't cost that much. For a few £100s you can really take away a lot of the risks in any business exercise, and there always is a risk. And then take on advice. Make sure nobody's an expert in all areas. In fact, probably anybody's only an expert in one or two areas. So get advisors around you, whether it's on pro bono or just actually paid for, or maybe even somewhere in between, and just make sure you actually take as much advice as you can in all of the specialist areas that you're actually working in. And then as the exercise grows, as you start taking on perhaps employees or workers, getting the right people on the bus. I think it was Jim Collins, Good to Great, that had that kind of phrase. That's key to actually making things work. I've seen so many successful social enterprise leaders say that their #1 tip is to make sure the right people are involved in the project. It's got to be people that get on, that really understand what you're trying to achieve and really want it to work. So those are my little tips, if you like, for making a social enterprise work. And the next area I'd like to just look at is to do with trading entities. Now, I know within the Unlimited series of webinars there's been webinars specifically on trading entities, or in other words legal structures, so I'm not going to go through all of the background detail to each of those possibilities, but I did notice that the webinars that have been from a kind of technical and legal point of view, which is very useful, but have perhaps not highlighted the tax issues, so that's what I'd like to do at this point. So the most basic kind of entity that one can basically operate a business as is a sole trader, or if there's multiple people operating in a similar way, just coming together and getting on with a project, that might be a partnership. A sole trader or partnership, from a tax point of view, basically pays income tax at 20 or 40% depending on how much your earnings are, and then most importantly pays national insurance at 9%. The reason that national insurance is important is because it's the national insurance that actually varies amongst these different kind of structures. The tax situation will tend to be relatively similar regardless of which structure we're in, but the sole trader or partnership, they're generally paying 9% national insurance on the majority of the profits. The other point on sole trader or partnership is that we're taxed and pay national insurance on the profits regardless of whether we actually take them out of the business. So if we're making profits which are then kept in the entity for future projects, we're still going to pay tax on them just the same as if we're taking them out to fund our lifestyle. A limited liability partnership has a very different legal and different set of accounts and very different approach for a standard partnership. However, an LLP is taxed and has national insurance exactly the same as a standard partnership, so effectively the same as a sole trader. So an LLP again pays tax at 20% or 40% depending on the individual's marginal rate, and pays this bulk of 9% national insurance. Probably the next most common kind of trading entity is going to be the limited by shares, and that's perfectly acceptable for a lot of social enterprises. Can be discouraging from some grant providers and some other kind of stakeholders who want to deal with a pure limited by guarantee where there's no possibility of dividends, but for a lot of circumstances a limited by shares is acceptable and certainly can be a social enterprise. The advantage of a limited by shares is that potentially the money can be paid out, or profits can be paid out to the founders or owners of the shares with no national insurance. I can't go through great detail at this point, but in effect, if you're a single person trading as a sole trader, you'll pay your tax plus 9% national insurance. Trading as a limited company, potentially you pay the same tax with no national insurance. So that can be up to a few £1,000s in saving by simply trading through a limited company with shares. A company limited by guarantee can't pay out a dividend, and that has quite a distinct disadvantage from a tax and national insurance point of view. Specifically, to get any money out of a limited by guarantee to the directors, they can't be shareholders, so they can't have a dividend, so they'll have to be paid a salary. When they're paid a salary, there's employees and employers' national insurance. I'll just open up another slide that shows some tax figures. Let me just make that a little bit bigger. We can see here the national insurance rates. Employees' national insurance is 12%, employers' national insurance is 13.8%. So if a limited company limited by guarantee is paying out a salary and there's national insurance on that, potentially paying 25.8% national insurance, compared to the same exercise and a limited by shares might not be paying any national insurance. So again, a limited by guarantee can be paying a lot more, maybe £5,000 per person in terms of extra costs paid to the revenue. So these are important points to consider when deciding which of these structures is right for you. Community interest company and an industrial provident society, again I won't go into the details of why you would choose those or what the legalities actually are because that's been covered elsewhere, but in terms of tax, pretty much similar to a limited by guarantee. And incidentally, all of these structures pay corporation tax on the surpluses of the social entity. There's quite often said to me, well, I shouldn't be paying any corporation tax. I'm a social business. I'm making profits purely for future projects. Surely that means I don't have to pay any tax on them. Unfortunately, that's not the case. Assuming we're not a charity, then any surpluses within any of these structures is going to have a tax charge on them. Noted there, charitable incorporated organisations, or indeed any charity, might be a company limited by guarantee that's registered as a charity. The same would apply. Charities don't have a blanket exemption from tax, but for most activities, certainly receiving donations and grants and the like which are used for their charitable objectives, there's no tax charge on those. And if a charity has a trade which is specifically achieving its own objectives, then there's also no tax on the surplus within that trade. If a charity has a trade which is generating funds for its main objective, but the trade is actually doing something different, then, as recommended by the revenue, we can set up a separate subsidiary company. The subsidiary pays its surpluses as a donation to the charity, and that structure then has no tax charge. Charity also has to pay money out to people to do work. Might be the founders, might be the people actually running the projects, or that might be the same person or people anyway. And when the charity pays out, just the same as with the limited by guarantee, we've got to pay that as a salary, and we've got to pay the national insurance potentially at that 25.8% rate. So, having established that we're trying to make a profit or surplus of some description, and we're probably going to pay some tax somewhere along the line, an important element of all of that is keeping record of what's actually happened. So, simplest bookkeeping. I really stress that our idea of Green Accountancy is not to complicate things, not to find problems where there isn't one, but instead to make things as practical and as simple and sensible as possible. And if we are highlighting problems, it's with a view to saying, okay, let's solve these problems and not have a later problem with the revenue and so on. And so we really want to be practical and do things the way we would want to receive them if we were on the receiving end of this information. And with that kind of context in mind, we've built a simple spreadsheet called the Green Accountancy bookkeeping spreadsheet, which hopefully you can see on the screens now. And you can see there's quite a lot of tabs in that spreadsheet. It's not anywhere near as complicated as it may first look, in the sense that a lot of those tabs have exactly the same structure. And I'll just go through this because this is freely available to anyone. Incidentally, you don't have to be a client of ours. Anybody can download this spreadsheet from our website, or just ask and we'll email it across. And you might want to use it, or you might want to use your own system or something similar, but hopefully the points that I can make on how to use such a spreadsheet will be useful to you, whatever your bookkeeping system is. And perhaps that's a good example of perhaps people could send a message in to Marika using the chat facility of what kind of bookkeeping systems are actually being used. So this bookkeeping system, our idea generally is that yellow cells mean to enter something in, and you can see there I put in a business name just as Green Accountancy and some dates as just showing the current calendar year as our business. You would fill these kind of details in, whether you're VAT registered and so on, and we'll come on to VAT later in the webinar, but you would fill those kind of details in as a one-off exercise. Then the actual transaction keeping, I stress keeping things as simple as possible. We've got to keep records under the following headings. So we've got to keep a date for each transaction that happens on our bank account, some kind of description. Now the date and the description we might be able to copy and paste either straight from our online banking screens or from a CSV file that we download from online banking. We've then got to tell the system what kind of thing that is. So if I just put in an example transaction as we go along, and enter some details in, I choose then what kind of transaction this is. So I'm going to say it's an advertising transaction, and I'm going to say it's cost me £50. For just simplicity, for this purpose, we'll imagine we're not VAT registered, but if we were, then we'd also say how much of that was actually VAT. Simple as that. Keep in the date, description, what type of thing it is, and how much money it was for every single transaction on the bank account. And we can see here the system will show us a running balance, and the key with any bookkeeping system, whether it's your own spreadsheet right through to the most complicated desktop software and anything in between, the key is keep the bookkeeping system bank balance to agree to the bank statement bank balance. If you've done that, then you're 90% there at least in terms of having good bookkeeping. Every time we receive bookkeeping records, no matter what type of system it is, the first thing we're checking is, do they actually agree to the bank statements? If not, is it going to be a real job to find out why not? So hopefully by entering transactions on a regular basis, you can, as soon as that balance is anything different from what's on your bank statements, you can quite quickly see where it's gone wrong and make the corrections. So keep a track of what's happening in the business bank account, and this would apply to any of those trading entities, whether it's sole trades, partnerships, companies, whatever type of company, CICs, charities, whatever. You just keep the same kind of records. Second tab here, Bank 2, is just simply the same, but for if you've got a second bank account within the entity, and the same again if you've got a credit card within the entity. And then the Proprietor tab works again exactly the same in terms of just keeping a track of transactions, but this time it's saying basically transactions that have been paid for by the proprietor, in other words the owner or founder of the social enterprise. So again, whatever type of entity you've got, whether it's sole trader, company and so on, you'll sometimes pay for, say, some travel costs, pay for a train ticket on your own debit card, and that's not appearing on the business bank account. So to get it into the system, we would just enter in here some kind of date, what kind of thing it was. See if I can find travel on here reasonably quickly, and how much money it was for. Again, negatives because it's a payment out. So I've entered in those details, and we can see on the summary that I've now got here an advertising cost of £50, and I've also got a travel cost of £25. I'm highlighting that because it's important to remember that from a business point of view, it doesn't matter whether the expense was paid for straight from the company's bank account, or from your business bank account, or from your private bank account. They'll all add up and they'll all become expenses of the business, in this case coming to £75 so far of expenditure. The other type of tab we've got here is sales invoice. We've got to be able to keep track of our sales invoices, so I've pre-filled one of the lines there because I didn't fancy trying to fill it in on the fly, and just put in a simple sales invoice of £100 against a customer called a customer, and we can use this system to print off an invoice or just simply print our own invoices and just record them on this tab. So having recorded that £100 sale, we can see that in terms of our sales figure up here. We might have had some other types of income, as you can see listed here. All of those kinds of income add up to our total income for the enterprise compared to our total expenditure, and we can see then we've got a £25 profit. So it's important to keep some kind of bookkeeping, and this is the most simplest that we're aware of way of doing it. As a kind of memorandum to all of that, in other words, as an additional piece of information, we can keep some other details. So we can keep track of the fixed assets, i.e. computer equipment, office equipment, that kind of thing, just listing them out here, what date, kind of description, what date they were bought, that is, description of what the thing is and how much it actually costs. It's actually a legal requirement of companies to keep that list of fixed assets. From a tax point of view, it's also useful, and from the accountant's point of view, come year end, it's also really useful and definitely save you on fees if you can just keep that going yourselves as you're going along. Now, any of these entities are able to claim other expenses, and I'll come on to tax minimisation, but basically one of the areas to look at is to think about home or private expenses, and is there actually some kind of business proportion of those? There's a general rule in tax that if you pay for something that's partly business, partly private, then the starting point is to assume you cannot get any tax relief on it at all. But that's not always true. If some kind of element of the expenditure relates to business, so for example a telephone bill might have some calls which are business and some which are private, then you can claim a proportion of that cost. And similarly, we can claim a proportion of our home costs if we work from home. The mechanisms for doing it are quite different and probably too much for me to describe right now, but regardless of what type of entity you have, company or sole trade and so on, you can claim a proportion of your home costs if you work from home. And the type of costs we're talking about are rental costs or mortgage interest, as the case may be, utility costs, i.e. gas, electricity, that kind of thing, council tax, telephone, and maybe others. Some people put cleaning costs, gardening costs, depending on your particular lifestyle. So those are added up then to the total costs that you have at home, and we need to figure out what proportion of those costs actually relate to business. Now, if the home is shared with a number of adults, then obviously then your share has to be calculated. So if you've added up all of those costs and it's for actually 2 people living at home, then only half of those costs are going to be yours. And then of that proportion, we need to think about how many hours per week we work from home. And bearing in mind there's 168 hours in a week, so if we work at home, say 17 hours a week, that's a 10% claim. So even if we work at home full time, say 40 hours a week, it's still only a 25% claim of the home costs. And then to claim whatever figure that comes out to be, what we would do in this system is put it on here as a use of home as office claim and be able to basically charge the company for using your home as its office. Similarly, we might have a car that's used in the business. Now generally, I'll come on to some specific exceptions to this when we talk about tax minimisation, but generally we would not put a car actually within a business, but we can still claim a little bit of costs against a car use, or for that matter a motorbike or bicycle. And what we would do there is just enter the date, what type of vehicle we're talking about, how far we're actually, where we're actually going, why we're going there, that kind of thing, some kind of description, and how far it was. And then this would just say, okay, we can claim this much money, and that's what's called a fixed profit expense rate, and that again we can enter as a claim against the company and against its profits. And then finally, in terms of record keeping, need to, if we are limited by shares, and this time this tab would only apply to a company limited by shares, we need to keep a record of our dividends. Really important. A bit outside the scope of this particular talk, but there's always a risk that dividends would get treated by the revenue as salary instead, and to minimise that risk there's various steps including keeping these kind of records. So this bookkeeping system would just help you do that. But going back to the summary page, that's the most important thing, to be able to see at a glance where we're at in terms of income and expenditure, regardless of where that income and expenditure came in and out of the business, and that's all summarised on here. And as I say, this is a free system and hopefully is the quickest system you could possibly use anyway. Other systems do exist, of course, and are perfectly valid. Anything above a kind of one person, one or two people situation, you're probably getting beyond spreadsheets anyway, in which case we'd look at an online bookkeeping system. We kind of use and therefore favour a system called Cashflow, spelled with a K. Apart from its odd spelling, it's a really good system. It works very simply, very cheap. In fact, clients of ours can use Cashflow free of charge, and that's fully featured. It has every feature that a system such as Sage would have had on the old desktop systems, but it's so much easier to use and so much more friendly for a person who's not that familiar or maybe not even that interested in bookkeeping. So online systems are really good and really easy to use, and obviously you log into them similar to you would an online banking system. Keeping records for business tax and VAT. I'll talk more detail on VAT towards the end of this talk, but at this point I can just mention the kind of record requirements. For business tax, there's no particular requirement in law to keep any receipts. People often say to me, well, what do I need to keep? But I'd always say, well, there's no requirement to keep them, but it makes sense to keep your records. So if you've got an email confirming your purchases from an online retailer, or you've got your actual purchase invoices that you've paid for a worker, then keep those kind of records, because although there's no requirement to have them, if the revenue ever did ask you to prove your expenditure and you've got nothing to support them, then it can become a bit of your word against theirs, and obviously it's just so much easier if you've got some paperwork in the background. So keep your records for business tax even though there's no particular requirement to, and keep those records for about 7 years at least. For VAT, there is a legal requirement to actually keep the records. You can only claim back the VAT on when you've got a purchase invoice that shows some VAT on it and there's a valid VAT invoice. So if you're already in the habit of it, though, there's no extra requirement. One thing just to note on bookkeeping is that barter transactions are fully taxable, unfortunately. It's all too easy to think, well, we'll just get somebody to help us with a little bit of work, and in return we'll give them a free of charge part of what we provide, our membership or whatever it is of what we provide, and we apparently seem to save tax and VAT and national insurance. Unfortunately, that's kind of Del Boy kind of tax planning, and it just doesn't work. In fact, barter transactions are just as taxable as money transactions. You simply have to put a value on those transactions. So if somebody does work for you and in return you provide them the service and with some of your services, then in effect what you're doing is selling your services. If you're VAT registered, that's a VAT transaction, and what you're also doing is paying that person for working for you. You might have to pay the tax and national insurance that's inherent on that. Frequency of tasks, just really wanted to mention that Revenue recommend that bookkeeping is done weekly. I think as an owner of a social enterprise, if you've got a kind of daily habit of being at a desk and being in a kind of admin mode for even just 5 minutes at the beginning of each day, then download those bank transactions. It's perfectly possible these days on a daily basis just to keep track of where everything is. Having said that, it's perfectly sensible to update your bookkeeping on a monthly basis. I think beyond monthly gets a bit tedious and becomes then a bit of a mountain to climb when you come to do it, and gets put off even more. So anything kind of daily, weekly, monthly is fine for updating the bookkeeping. In terms of looking at management accounts, either monthly or quarterly, I think there's quite a strong argument to say quarterly is useful because there's more realistic actions you can take by the end of the next quarter, whereas when you look at management accounts on a monthly basis, it can be a bit so short term that any fluctuations are explained away by it being, oh, a funny month, and also so short term that it's difficult to really influence things by the end of the next month. So quarterly for management accounts is quite a sensible approach. And also financial forecasts are an area in their own right, in so much that I don't particularly see the need for a detailed financial forecast. If you're going to do any kind of forecast, then keep it simple, keep it really simple. We've got a simple idea of how much income we're trying to generate each month or something like that. Any of these kind of online bookkeeping systems don't really lend themselves to financial forecasts, but we've got some templates, again, we'd be happy to share, that can set up a forecast, and then you can start tracking your variances against it. But to be honest, I think that's a little bit beyond certainly beyond the startup situation. So tax minimisation and tax-free income, kind of highlighting the picture of the bus there, just because you can provide a bus, but I don't think there's many of us, probably not in this particular webinar, that are at the size that we're actually going to take on a whole bus to transport our workers into our office or factory. So more realistically, what can we do to minimise tax? Well, first of all, tax is a charge on surpluses, and we want to make a surplus. So, you know, give me £100,000 tax bill, I'll be quite happy, because then by definition I've had a nice bit of income. But that kind of highlights the point that if we do spend money on tax deductible expenditure, we've bought some advertising, we've bought in some services, whatever it may be, of course we're spending £1, we're saving 20 pence in the pound. So it doesn't make any sense to just spend money on deductible items just for the sake of saving tax. If we are going to have some discretionary expenditure, it's more the timing which can make a difference rather than the absolute pounds. We'll buy things because we need them, not because we're saving tax, but what we can do is make sure we're buying things in the right time, certainly in terms of our year end. So if we're a sole trader or partnership, usually our account date is 5th of April. For a company, it could be any month end. Whatever your account date is, if you've got some discretionary expenditure, spend it before the account date. That way you're accelerating your tax relief by potentially a year. Pension planning is a specific area that requires the money to actually be paid into a pension in order to get the tax reliefs that are attached to pensions. And dividends, similarly, if you're going to get dividends into a certain tax year, then you need to have actually paid them, or at least voted them, by the 5th of April. Specific point on that slide mentioning grants. And the reason for that is because it's a slightly complicated area compared to most other forms of income and transaction for social enterprises. Nothing particularly rocket science about it, but it just has some specific little rules around it. And certainly from the point of a social enterprise, it can feel particularly unfair if you receive a grant which is going to be spent over a number of years to then find, well, actually you've got a surplus. Generally grants are taxable income, you've got a surplus and you've got to pay some tax on that money. So let's say we receive a grant for £30,000 and we're going to spend that over 3 years, and at the end of year one we've spent £10,000. All things being equal, we've got then a £20,000 surplus, we've got £4,000 tax liability. Now we can avoid that tax liability if and only if that grant is actually for specific expenditure. If the grant terms say, and you will spend this on the project for paying somebody's salary, for example, over 3 years, then we'll pay that salary over 3 years, and we don't have to treat the surplus in the first year as a surplus. We use what's called a deferred grant. We only treat the income as and when we spend it. So assuming we're spending it on business activities, then there's no tax because the grant and the expenditure are matched together in the same period. However, if the grant terms don't specify so clearly what it's for, it just basically says to support your project, and we just happen to decide to spend it on somebody's salary over 3 years, then that grant can't be deferred. So that's quite an important point when you're looking at grants, is to make sure if it is going to be used over a number of accounting periods, that it actually has specific expenditure in mind in the grant terms. I've already talked about the importance of trading structures and how that can influence the amount of national insurance. If we are in a situation where we're either a sole trade with employees or we're a company and we are an employee or director ourselves of that company and maybe with some other employees, one way or another we're paying some employees, then there's some tax-free things we can give them, or give ourselves for that matter, including one mobile phone per person, pension contributions, bicycle as long as they use it to come to work occasionally, then private use is overlooked. We can give them an electric car, that's something I use, no tax benefit on that. We can give them some nursery vouchers, we can give them teas and coffees, and what the revenue call trivial gifts, such as a bunch of flowers they give as an example. So how generous of them they let us give our employees an annual birthday card. I think it's mentioned at one point in the guidance would not be taxable on them. Most other things in the whole world that I haven't just mentioned, if we give to our employees, are taxable items one way or another. So paying workers, so that leads us on to actually paying people. And I can see we're slightly running over on time compared to where I wanted to be. But I think this is quite an important area. Paying people is a classic problem area for many social enterprises, in fact all small businesses. If we pay somebody as a freelance worker and they're actually an employee, then there can be big national insurance consequences that we may not have been even aware of, and they can rack up over a couple of years. Revenue can potentially add penalties and interest, and we can get into quite big bills from relatively small situations, enough to actually close down an entity. And the problem area there is just paying somebody as a freelancer when really they're an employee. And often people will say to me, well, this person's definitely a freelancer, they're registered as self-employed, or they work from home, or they work flexibly, it's only short term, all sorts of things, and none of those things make any difference whatsoever. An employee can easily be registered as self-employed, work from home, flexible, etc., etc. So the actual thing that makes somebody freelance or employee, first of all, is they have some kind of business characteristics, and typically that means they can profit or lose by the quality of their work. If you imagine an employee who turns up for work and gets it wrong all day because they just didn't quite get the task, they just come back the next day and redo it, and they get paid for both days' work as you would as an employee. Whereas if you're truly self-employed, operating as a freelancer, in that situation you'd have to put good your mistakes at your own costs. And similarly, a freelancer should be able to profit by making the work happen more quickly than might have been anticipated and still getting paid the same amount. Whereas if the employee gets their work done by 2 in the afternoon, generally can't just walk down to the park and still expect to get paid a full day's work. So that's quite an important point of whether somebody's freelance or employees, can they profit or lose by the quality of their work. And then legally, there's some points called control, basically who controls the methods of work, obligation, that means is there a notice period, substitution, that means can they send somebody else, and those factors, unfortunately I can't go through the details right now, but those factors are what technically makes somebody employee or not, simply those 3 things, control, obligation and substitution. And just on that point, a special rule for a director is that a director is by definition within the pay-as-you-earn scheme. You cannot be paid on an invoice basis to your own company. There's some slight exceptions, but in 99% of cases a director has to be paid with the normal pay-as-you-earn and national insurance that would apply to an employee. Now, Marika, I see we're up to time, and I'm not through the slides as intended. What's your thoughts on continuing on for 5 minutes in terms of presentation?
Oh, hi, David. Thank you for that. So we are now at 1:45, and we've got until 1 o'clock. So maybe now would be the time for people to start thinking about questions. I've got one here down already, and then actually I've got one of my own. But if everyone wants to think about, if there's anything from what David's been talking about that you'd like to either clarify or ask something that perhaps you thought would be covered, but we haven't yet. And then we'll see how that goes. I think that, David, if you want, is there something still that you wanted to cover? I think we could go on for another 5 minutes or so quite easily. And
yeah, sure.
The last 10 minutes? Yep.
Okay, well, you interrupt me as and when you feel we certainly won't get through the whole presentation. It's interesting, when talking on these webinars without an audience, you normally fly through the material much more quickly than anticipated compared to being in a room full of people who are kind of asking questions as we go along. So it's good that we've got enough material to fill the space anyway. So just looking briefly at basic payroll. So setting up a pay-as-you-earn scheme is actually really easy and nothing to be afraid of. If you have got people who need to be paid as employees, and obviously if you've got directors, if you're a company, they need to be paid through payroll as well. Payroll is for officers and employees. And setting up that payroll is really simple, online situation. And once set up, you've got to then comply with a payroll system that the revenue call real-time information, RTI. And what that basically says is that the revenue need to be informed electronically every time somebody is paid, and the rule says on or before when they're paid. Now there's a relaxation for small employers which says you can tell the revenue any time by the end of the month. But effectively, every time you pay somebody, you've got to make a submission to the revenue telling them what's happened. And the revenue are going to use this real-time information to help understand what benefits people should be paid. So, I mean, set up the scheme, you need some piece of software. You can buy really good software for £100, or there's online systems, or get an accountant such as us to do it for a few pounds each month, whatever. Get some way of generating your pay slips from a piece of software that you can then use to the same piece of software to inform the revenue of the monthly situation. Employees joining, they will either give you a P45 from their old job, or you can just ask them a series of questions, what used to be called the form P46, but P46 has gone away now. It's just basically starter questions. What that really says is things like date of birth and national insurance number, but also does that employee have any other work? Now, when they're asking that question, other work can mean self-employment or employment. So if the person's got some other kind of income, then they're going to get a different tax code within your payroll compared to if they haven't. And once they're on your books, the revenue will issue a tax code anyway to tell you how much tax to deduct effectively, or at least for you to enter into your software so that the software can work out how much tax to deduct from the employee. And then simply, if the employee's gross pay, let's say, is a couple of £1,000, and the tax situation is they're going to pay £300 tax and £200 national insurance, then the pay slip will show those as deductions, as you would expect, and you will have no doubt had at some point in the past of your own employment, and you pay the employee the net amount, and the employees and employers, national insurance and pay as you earn, all gets paid to the revenue, usually on a monthly, sometimes on a quarterly basis. This particular year is the first year of a £2,000 gift, if you like, from the government to all businesses that are employing someone, in so much as the first £2,000 of employers' national insurance doesn't have to be paid. That's apparently going to be an ongoing thing, or at least it's an ongoing every year thing until they decide that they've had enough of it, which might well be next year, I don't know. But for the time being, we've got a £2,000 annual holiday from paying employers' national insurance. The software that you use for running your payroll will give you your year-end forms and the P60s. So even though we're in an electronic era and RTI and all the rest of it, there's still a P60 sent to each employee at the end of the year. Benefits in kind mentions there. So I mentioned before, if you give anything other than the basic pension, mobile phone type things which are tax-free, anything else such as a car or a suit or a holiday or pretty much anything you give to your employee that isn't just cash, then it might become a benefit in kind, and that has to be reported on a P11D, and that means their tax code changes and they pay some more tax. That's basically how that works. A P11D is for benefits and expenses. So if somebody's reimbursed some expenses, such as the train fare, you think, well, there's no tax on that. The whole point of this situation is that it's a tax deductible journey. But nonetheless, the revenue want to know about it. You've given your employee or director some money. And the form P11D is benefits or expenses, and in which case the train fare would go on the expenses column, and they might not have to pay any tax on it, but it's still absolutely a requirement for it to be reported. Unless, however, you've got a dispensation in place. So form P11DX would recommend every single employer always completes a P11DX when they first become an employer, and what that does is invoke a dispensation which says, okay, if the expenses are not actually taxable and in certain other criteria, we don't have to bother reporting them. And the revenue will almost always agree to that dispensation and will apply it from the tax year in which it's submitted, so you can't really backdate those things. Final point on that slide is just saying, okay, if I've got my own company, can I just pay myself a salary, a dividend, a loan or an invoice? Well, dividend obviously only if from a shareholder. Dividends have to be proportional to shareholdings, and they're in a sense the best thing because there's no national insurance at all on those. Next choice, salary. Well, okay, great, I can pay myself a salary from any situation, but I'm going to have to pay 25.8% national insurance. But those are the two realistic choices. It's kind of footballer tax planning to think about just taking a loan from the company and never paying any tax because it wasn't actually my salary, it was just a loan. So we wouldn't get involved in that one. And as I mentioned before, as a director of my own company, I'm basically not allowed to invoice that company on a freelance basis, even if the work would be of a freelance kind of characteristic. So there's just some details about how payroll works. And then in terms of basic VAT, and the first thing I'll say about VAT, value-added tax, I think it's a misnomer, but a great misnomer. I think it really is consumption tax, but somehow value-added, which seems like quite a modern era kind of business kind of phrase, got used back in the 70s to call this tax value-added tax. In fact, it's a consumption tax. It's nothing to do with value added, in the sense that it's not a tax on business at all. From an environmental point of view, incidentally, it's a great tax. It just really should discourage consumption. From a business point of view, it's also fine, because if you are VAT registered, VAT shouldn't actually cost you anything for most businesses. Now, you have to actually be a business to register, so often a charity, for example, can't register. Not always the case, but usually a charity isn't actually a business. It hasn't got a possibility of making profits. You don't have to actually be profitable to be a business, but as long as you've got a kind of look like a business, and the revenue, you've written a whole book on what is a business, then as long as you look like a business, then you can register for VAT if you want to, and if your turnover is more than 81,000, then you have to. On that turnover threshold, if you're avoiding VAT registration for as long as possible, specifically because your customers are not VAT registered and you would be uncompetitive if you had to register yourself, then do make sure you make that test on the end of every single calendar month, looking back 12 months. Don't wait until the end of your accounts year till your accountant gets hold of your figures and then tells you actually you should have been registered 6 months ago. Because when you look at that threshold, if you've gone over at the end of any given month, looking back 12 months, then you've only got 1 month in which to register. So I've mentioned kind of, or implicated, the idea of voluntary registration. Why would I want to register before I get to that threshold? Well, as a business, I might well do if my customers are all or predominantly VAT registered businesses themselves. So if I'm supplying business-to-business supplies and my customers would be able to claim the VAT back, then it's better to VAT register, because they don't care that I'm adding 20% to the invoice, they can claim it back. But what that's enabled me to do is then reclaim the VAT back on my costs. Or indeed, I could join the flat rate scheme, and I would only do so if it's beneficial, but the flat rate scheme basically says still charge VAT at 20% the normal rate, assuming the kind of goods you're supplying or services you're supplying are normal main rate supply goods, still charge 20%, but only give the revenue a proportion of that 20%, and that can leave you easily £500, £1,000, £1,500 in pocket over a year. And so VAT registration can be quite a significantly beneficial thing to do, as I say, as long as your customers are VAT registered businesses. Marika, I guess that does take us up to time.
I think it does.
So carbon accounting will have to wait.
I think it does. I think it does. I think if anyone's interested, so carbon accounting is another sort of specialist area for green accountancy. So if anyone's interested in finding out more about that, then do let us know.
We'll have another webinar another day.
We can do another webinar. I do have a couple of questions, and interestingly, they are sort of more to do with the recruiting and the sort of HR side of things. So I'll just give these to you, David, and we'll see if these actually sit within your expertise. I'll
have a go.
Well, yeah, if we'll need to take them elsewhere. But Joe was asking about if you have any signposting towards a bit more information regarding freelance workers working for a social enterprise. She was particularly interested in a bit more detail on the section where you were talking about control, obligation, and substitution.
Yeah, absolutely we have. Now, as a lot of people often say, our website is under development. We're about to get a new one and all of that, which we genuinely are. So our website looks a little bit old-fashioned, but the content is there. And if you have a quick look here on our website, we can look at resources, frequently asked questions, and if we can just get to it, employment status. So that gives a bit of information here about the whole thing about control, substitution, obligation, and so on. Probably a bit small to see there, but you can see basically go to greenaccountancy.com, resources, frequently asked questions, and then employment status. Yes. Does that answer the question?
I can't speak on behalf of Joe, but hopefully that is helpful. So what we will also, when I send a follow-up email after this, I will include I'll include a link to your website, David, and then people can look all this stuff up. There was also, I think, right in the beginning, you made a reference to a book.
Okay. Yes.
By Michael somebody.
Yeah, Michael Gerber.
Okay,
again, Marika, I'll give you that reference on an email and you can pass that on. I wouldn't like to try and spell his surname off the top of my head. Partly from a memory point of view, I just can't remember. I think it's Michael Gerber, and the book is called E-Myth Revisited. E-myth being the entrepreneur myth, in that he claims that there's no such thing. In fact, what there is people putting together systems and making a kind of machine that does things, and that's the whole point of being in business. Which might sound a bit radical, but actually it's quite a gentle book. It's quite a almost a novel narrative to part of it, and it's just quite. It's a little bit fun. It's a little bit soft touch. But I think it gets across some of the points really well.
Brilliant, thank you. And another question, just about, I think you may have covered this, but just to sort of remind us. So, at what point are people legally sort of needing to start reporting on? Obviously, you want to keep your finance records from the very beginning, so that you know what's coming in and what's going out. But is there a point
good
that
question.
is legally required to report on that?
Yeah, good question. Okay, well, if you're setting up as a sole trader or partnership, you have to tell the revenue that you've done that by the 31st of October following the tax year in which you started. That's quite a long time frame. You report that on a form called a CWF1, and you can do that earlier, so you don't have to wait until after the end of that first tax year. In fact, it makes sense just to tell them as soon as possible. But you don't have to tell them any information about what you have done if you're a sole trader or partnership, until you come to the end of that first tax year, 5th of April. You've then got until the 31st of January following that. So if we started a new enterprise right today, our first 5th of April would be 5th of April 15. We'd have until 31st of January 2016 as the absolute outside deadline to provide any accounts and tax return. Now, if we register for VAT, then that's usually a quarterly, can be monthly at our option, but let's say quarterly requirement. So once we register for VAT, we've got to give them our VAT figures, which includes our income and expenditure, on a quarterly basis. And as I said, if we register as an employer, because we're a company and we've got a director who needs to be paid, or we've actually got people helping us, then the real-time information means we've got to report that information back on a monthly basis.
Great, thank you. And just one final really quick question. If after this people still have questions, then I think, David, you kindly were happy to take them afterwards as well. So
yeah,
we'll pass on email addresses, etc., and then you can drop David a line directly. But the very
or if you go. If you pop onto our website, as you can see on the screen, can people still see my screen?
Yes,
you can click on here, book now, for a callback, and you'll get your options. You can book a callback, and you'll be able to just choose the day and the time that you want to have a chat on the telephone.
That's brilliant, really helpful, thank you. So really quickly, if someone is already self-employed and then they start another business, which is a social enterprise, do they need to register again?
It depends. Yes, it's a short answer. Yes, you do. It's definitely the answer, actually. Okay. Even if it's a separate sole trade, which is reasonably unlikely, it's probably a separate strand of the same sole trade. But if it was a separate strand of the same sole trade, I suppose there's no requirement to tell the revenue. That, in a sense, all we're doing is expanding our repertoire of what we're actually trading as. But if it's a completely different type of thing, a separate sole trade, or obviously if it's a company of any description, all the different types, then yes, we'd need to tell the revenue separately about that.
Hi, David. Right, I think we are now officially out of time. So thank you so much, and thank you so much for taking the time to be with us this afternoon. Thanks to everybody for registering and joining us. As I've said a couple of times, I'll follow up with the recording and any of the links we've discussed and then look forward to seeing you at the follow-up webinars or the rest of the webinar series later this spring. The next one I think is already next week. So any final words, David, and then I will just close this.
Yeah, just to say thank you, Marika, for inviting me, and thank you for everyone to attend this webinar.
Brilliant. Thank you so much, and have a good afternoon, everyone. Thank you.